Warren Buffett makes $1.5 million per day off of Coca-Cola dividends.
Wow.
Every day.
Yeah. That's where he bought his first Coca-Cola share when he's like mad young. The Intelligent Investor was one book that Warren Buffett's in a lot. We'll put a link to that in the description.
Psychology of Money as well talks about it.
Psychology of Money. We'll put the link to that in the description as well. You guys can check that out.
So how do we know, what to invest in, right? Obviously, as we mentioned, we're going to go through the checklist of exactly what the different categories are and what to look for. Just some of the things that I look at personally are, year over year revenue growth, the management team, their track record, the moat. The moat of a business is essentially what stops somebody else from doing what they're doing. Are they doing something that's so superior to what everybody else is doing? And then, the financials, right? Looking at those
basic numbers,
the balance sheet, like the cash to debt ratio. You don't want to buy a company where they have more debt than they have cash.
Yeah.
Right? Because more cash equals more opportunities. Less cash means you can't even pay off your debt, right? Look at the Evergrande situation, the China Evergrande situation, right?
I mean, if they're not getting backed out, then...
Exactly. And then I just want to talk about, market cap versus share price. Because I think that's a big thing for not new investors.
For sure. I mean, I only kind of learned that recently, right? And it's so huge.
Yeah. And for example, like one of my friends actually asked me one point, this is when I learned this, is... why is, Chipotle stock $1,300, but McDonald's stock is like $200, right? I didn't know. It's because...
It doesn't mean that Chipotle is more valuable.
Yeah.
It just means that they have less shares outstanding, right?
Exactly. So basically, market cap is calculated by share price multiplied by shares outstanding.
The share price is the market cap, which is the amount of money in that stock, divided by the amount of shares. That's how you get that final share.
Every company has a different amount of shares.
There's like a finite amount of shares that are available for purchase
for any stock.
That is called the float. The total shares outstanding minus the float are the shares that are locked up and that cannot be traded for a company.
Okay.
So essentially, it's two different things, but when you do the calculation, it's the total number of shares that exist. When you divide the market cap by that, you get the stock price.
The share price.
The stock price. Okay.
Just because you see a stock that's $200 and then you see another stock that's $25, the $25 stock might be way overvalued, and the $200 stock might actually be cheap. Might actually be a really good buy.
Because there's more stocks available.
Exactly. Exactly. So
there's less flow, which
there's less available. There's less in existence.
So in terms of Chipotle, so the reason why Chipotle is more expensive than McDonald's is because Chipotle has less available shares.
Is that why Chipotle stock price is higher?
Yeah. Because they have less available shares outstanding. That's available for to buy. Than McDonald's.
Yeah.
Well, but, both those numbers come into play, right?
The
market cap, the amount of the market cap.
Yes. Okay.
After that calculation.
That makes a lot more sense, though. Okay.
Yeah, and that's something I just learned not too long ago. He just learned not too long ago.
I feel like I saw this in a book. That's the thing, because you need to know each individual definition. So I feel like it just kind of went through one year and not the other, right? So
that's the reason we're touching upon this, right? Because a lot of people will look at stocks and be like, I don't want to invest this because it's already so high. That doesn't mean it can't go a lot higher, right? You got to look at the market cap, how much money is already in it. And then you can look at how much more money can realistically flow into it.
Yes, exactly. And like, for example, just put out there, Chipotle has, as of 2018, they had 27 million shares outstanding. You can determine if one is more valuable, is valued higher than the other. You know what I mean? You know what I mean? Like, what I do is I kind of compare companies to their peers in the space. For example, you would not compare Walmart to Tesla. They're not in the same industry.
Yeah, you would compare Walmart to Amazon,
Costco.
Amazon.
There you go.
Yeah. Or you might compare it to Whole Foods and say, okay, listen, well, Walmart's market cap is like up here, Whole Foods is like down here, but they do everything just as good as Walmart. They have just as many customers coming in. Their market cap's probably going to start growing a little bit closer to Walmart, which means that their share price is probably going to grow. You can kind of
and kind of
just
adding
like that.
Just adding to what Vino said is like one thing I look for. That's great that you mentioned that, because one thing I look for is you look at the market cap, not the share price, first and foremost. So for example, Whole Foods market cap was $5 billion, and a competitor of theirs market cap was say $100 billion. Whole Foods has more room to catch them.
Mm-hmm.
It has 20x to catch that.
Potential.
If you think that Whole Foods can grow to 100 billion, you compare their revenues and you think Whole Foods can make as much money potentially. That's just kind of like one of the many metrics that you look at. Because if you think so, then that's a great buy. Right?
Yeah.
You look at the market cap, right? 5 billion versus 100. If you think 5 billion can get to 100 billion, that's 20 times your money. In the future.
Exactly. And realistically, what's probably happening is that the 100 billion that's in this company might start a little bit slowly flowing into the 5 billion market cap company, because they're starting to do things a little bit better now. Right. And it's a little bit of basics there, right?
I'm glad we covered that. And then just the last thing, we just want to touch on before our camera here
gives
up
this
little thing is, different types of stocks. There's two different methods. There's dividend stocks and there's growth stocks, right? Dividend stocks are where the company takes their profit and they pay it out to their share. They take a portion of their profit and they pay it out to their shareholders, right?
As a thank you for, believing in them and holding with them, right?
And they share it with their shareholders. And the growth stocks take the whole profit and they essentially reinvest it back into the company. So there's no dividend, you don't get paid, but that company will grow more depending on how well the management spends that money. Right? So for example, all the highest market cap companies we talked about in the United States,
they're not dividend.
They don't pay dividends except for Apple. Because Apple has more money than it knows what to do with.
So that's one of those one-off kind of companies.
Hence why Apple's going into the metaverse.
I think that's one of the only tech companies that give a dividend. If
exactly. Microsoft also.
Okay, they both do. Okay.
Yeah, but for example, Amazon, Netflix, Tesla.